Without further ado, I'd like to introduce this morning Dave Bellusci.
Thanks, Chad. Good morning, everybody. As Chad mentioned, I'm Dave Bellusci, Chief Actuary at the WCIRB, and you go to the, let's see, get these going, there we go. And I know everybody likes it, early morning to listen to a rating bureau actuary geek talk about experience rating for an hour, but I'll try to be human or something close. And anybody asks the questions, I won't call them a nasty woman or part of the band of deplorables, or question the size of their hands, or accuse one of their parents of being involved in the Kennedy assassination. So hopefully this will go pretty smooth. So first, who's the WCIRB? The WCIRB is California's trusted, objective provider, and you can read the rest of it. So really what we are, we're the licensee of the State Insurance Commissioner. We're a nonprofit association of insurers funded through premium riders. And what we do is really said in that, is really described in that mission statement, providing objective information about the workers' comp system. Actuarially-based research, as really we think is important for and integral to really a healthy workers' comp system. Well, our role in experience rating, which is the topic of this morning's presentation, is to first collect all the data that goes into an experience modification. And for those of you who aren't too familiar with workers' comp, I'll go into a little bit about experience rating and what it is in a minute. And then we collect all that data, we publish an experience modification for all eligible California businesses, and that's about 120,000 a year. And then, as we've done recently, we recommend changes to the experience rating plan to have it perform better with respect to its statutory purposes and why we have experience rating. And let me go first to what experience rating is. And this is in the legislation, so it wasn't written by an actuary, but it's not bad. It describes a rating procedure, and we tried to underline sort of the key parts of it. So it utilizes a policyholder's past insurance experience, again, at the individual policyholder level, to predict or forecast future losses. So it uses the past experience to forecast future losses by measuring that policyholder's loss experience against the average expected for all the policyholders in the same class. So again, this is a classification-specific measure. You can't compare the mod of a roofer to a restaurant, or a school to a bakery, right? It really compares all the businesses in a class to all the similar businesses in the same industry. And then it produces a prospective premium credit debit or unity mod. That's section 11730 of the insurance code. So again, remember the key part of this is it uses the past experience as a predictor of future cost. So it's not a recoupment, it's not like a retro plan or some kind of dividend plan where it's sort of after the fact, it's a predictor, it's a prospective measure using the past to sort of forecast the future. And what does the law say about its requirements? Well, they should be reasonable eligibility standards. There should be adequate incentives for loss prevention and sufficient premium differentials to encourage safety. And remember you can pick up those last two because we'll come back to it. It's really about putting a financial incentive in the system to promote a safe workplace and avoid workers being injured. Well, one of the fundamental concepts around experience rating is how much weight do you give to the severity of a claim, the cost of a claim, with how much weight you give to the fact that claims occurred in this measure that, again, uses the past experience of a policyholder to predict future cost levels. And in a shorthand way, we'll call it claim severity versus claim frequency. How much an individual claim costs compared to how many claims happens. So which does an employer have greater control over? Which should be given a greater weight? Well, in this example, we looked at $80,000 claim versus 4 $20,000 claims. Both in total cost $80,000. But again, if we're using experience rating, the fact that a policyholder in a year had an $80,000 claim, well, it doesn't tell you a whole lot about what's going to happen next year. That $80,000 claim may be a once-in-a-decade claim, and it's very unlikely it'll occur again. Or it could be a very good year that typically there's 4 or 5 of them and there was only 1. So it's not highly predictive of what the cost is. However, when you have 4 $20,000 claims, it gives you a better predictor. Now they may not have 4 next year, they had 4 last year, but they're likely going to have 2 or 3 or 5 as well. So a much better predictor. The fact that that 80,000 tends to be much more predictive of what the costs will be in the future than a single $80,000 claim. So again, that's in essence why the experience rating gives more weight to the number of claims and the frequency component and less to the severity. So let me talk about split point. That's a sort of a key element of what we're changing in the 2017 plan, the change to the variable split plan that I'm going to talk about. A split point is used to divide claims into primary and excess pieces. The primary pieces, and I'll try not to get too actuarial here, are the more predictive and controllable portion. It tends to be more predictive. It's that first few dollars of a claim or first few $1,000s of a claim. It's used entirely in the experience rating formula. So under the old formula and under the new formula, up to the primary threshold is used at 100% in the calculation. Excess losses are the portion above the primary, up to the cap of $175,000. And that represents the portion that's less controllable. Well, under the pre-2017 plan, the extent the excess losses were used in the calculation depended on the size of employers. For very small experience-rated employers, they weren't used at all. For larger experience-rated employers, they were used to some extent. Under the variable split plan, they're not used at all. So really the only component of the variable split that's used in the calculation that counts against the employer in experience rating is the losses up to the split point. And this does place greater weight on sort of the controllable frequency component rather than the high cost, the high severity claims. This just shows a sample rate sheet under the old formula, the pre-2017, and you can see this is what a rate sheet kind of looks like. And each claim is divided between the primary and the excess piece, the primary piece being up to $7,000 under the old formula, going to $7,000. And then the excess is the portion between the total value of the claim and $7,000. So for example, that $34,000 claim, $7,000 goes into the primary piece, $27,000 plus change goes into the excess piece. That's under the old formula. And we'll talk a little bit about how it looks under the new formula in a minute. Well, why should we change at all? Change causes disruption in the, a little bit of disruption in the marketplace. Does include, as I'll talk about for a few employers, a pretty wide swing in their XMON, which could be pretty meaningful. But why change at all? Well, we hadn't changed it since 2010. And things in the claims environment do change. Frequent law changes, rates. The NCCI and most other states that use their plan had gone from $7,000 to a $15,000 that's indexed for inflation. So other states have looked at this and it increased it. We, in fact, if we had kept a single split and did the same thing, we'd probably go up to about $15,000 as well. And then when we looked at it, 7,000 split point really wasn't working that well anymore. It wasn't producing the optimal results. And by optimal, I'm going back to that statutory requirement that used the past to forecast the future. Well, the 7,000 split wasn't doing a great job of using that past experience to forecast the future. And then what we were seeing, the plan was becoming for very small experience-rated employers, the plan was becoming too volatile. They were getting too big of a hit for a significant claim than was warranted based on the actuarial analysis. And lastly, that formula is really complicated, and we'd love the opportunity to be able to simplify it. So let me go. Any questions in general before I get into the 2017 split formula? Any questions about experience rating in general? Okay, let me move on. So let me talk a little bit, and I won't get caught up to this too much, about what all us WCIRB actuaries played with for a number of years to come up with this, sort of our research. We did it on 4 full years of how, to measure the predictive. We didn't want to just do 1 or 2 years. We looked at 4 full years of measuring how well the past, how do we use that past to forecast the future. And what became pretty clear to us in all 4 of the years is that kind of one size fits all really doesn't work very well. It's less predictive, and again, our goal is to make it as predictive as possible, and it was creating additional volatility, particularly for small experience-rated employers. And by varying the split point, instead of using 7,000, or even if we had gone up to like 15,000, like other states had, rather than using a single split point, varying the split point based on the size of the employer really allowed us to make it more predictive, which was the goal of the actuarial analysis, make the past used in a way that's more predictive of the future, and reduce a lot of the volatility. And then what we saw by varying the split point, we didn't even need to use the excess losses at all. In fact, those excess losses really weren't adding anything. As long as we raised the split point, we weren't adding value by using those excess losses. That means those high claim severity, those really big jumbo shock loss claims, really weren't being very meaningful in terms of predicting future experience. It also meant that more weight was given to higher than expected claim frequency. It really put more of a focus on claim frequency, which again is the goal of experience rating, incentivize having fewer workplace injuries. So what were the changes? And these just went into effect. We just started issuing mods under the new formula a couple of weeks ago, I think it was. We got about 20,000 January mods on the street within a couple of days of the commissioner's decision. And so the split point, rather than being 7,000 for all experience rated, goes from around 4,500 for very small experience rated employers to 75,000 for the Walmarts of the world, UPSs of the world that have very large businesses in California. And it's based on the total expected losses, and that's the same as the eligibility calculation. I'll show that in a minute. And the claim amounts up to the variable split point are used fully in the X-mod calculation. So instead of always using just the 7,000, it'll use up to whatever that variable split point. Again, I'll show that in a minute. And then claims above the variable split point are not used at all. There's a second change that I'll spend a couple minutes at the end of the presentation related to the use of unaudited payroll on eligibility that I'll also talk about later. So let me just kind of demonstrate how we determine expected losses, or how expected losses are determined. And this is for one of our machine manufacturing classifications, 4410. In this, we'll assume they only had one class code in this simplified example, the policyholder. There's 3 years that go into the calculation. Typically, the 2017 mod will use the 13, 14, and 15 policies. You can see the reported payroll in the example, multiply it by the 2017 expected loss rate, come up with expected losses for the policyholder during the experience period, during the 3-year experience period, of about 124,000. That's far above the eligibility threshold, which is only around 10,000. And so the employer's total expected, so they're eligible for experience rated, And then that total expected losses of 124,000, which determines their eligibility, is also used to come up with their primary threshold. There's a really ugly table that we have in our plan that determines where it is. Well, that 124 is in that row between 122,975 and 128,845. So the primary threshold for that policyholder is $24,000. So again, remember the distinction. Under the old formula, that policyholder would have had a threshold of $7,000. Now it's $24,000, but in the past, a portion of their losses over $7,000 would have been used in the calculation. Now, none of the losses over $24,000 will be used. And I have a couple examples. So that's really the two key pieces of this change are the threshold is going to change. For small employers, it'll be less. For most other employers, it'll be bigger. So they'll count more of those first, in this case, $24,000 losses. But the losses above the threshold in the past, where they were counted for most employers to some extent, are not now being counted at all. This shows a little bit what the rate sheet will look like. We'll always show now the primary threshold, where in the past we didn't because it was always $7,000. So that'll vary depending on the policyholder. So that'll show on the rate sheet. And then you can see losses get split into their primary and excess portions based on that threshold. So in this example of a single $25,000 claim, 24 is primary. That'll be used. 1,000 is excess, and that won't be used at all in the formula. So, okay, what are the benefits? I think I talked a little bit about why we did it. We hadn't changed the plan. The plan was kind of out of whack. We needed to reflect the most current information. We wanted to reduce volatility. Well, what are sort of the byproducts of making the plan as predictive as possible, which we think this variable split does? Well, it does align with that purpose of experience rating that we talked about earlier. Provides a direct financial incentive because it's not counting the high claims as much. It's giving more weight around frequency and around, the first few $1,000s of a claim. It focuses more on what the employer can control, reducing loss frequency or preventing injuries from occurring. So again, it's really focused on the purpose of experience rating, which is frequency. It does reduce the volatility from those shock losses. That $100,000 claim, $150,000 claim is not going to hit employer anywhere as much as it did in the past. Claim severity is still a factor, but at high values, it's not predictive. The difference if you have a $50,000 or $100,000 claim for most employers really doesn't add much to the predictive value. It's more of a function of the injured worker, how well a medical treatment worked, things like that. It is more predictive, what our actuaries like. Makes the plan more accurate, predictive. It reduces, another benefit over the years, and I've been involved with experience rating now more than 25 years, one of the issues that always comes up is the variability around case reserves. Case reserving is more of an art than a science, and there's a lot of variability depending on who's reserving the claim by insurer and even within insurer individual adjusters. Well, now it doesn't matter as much because if your threshold is 20,000 for experience rating, a reserve of 25,000 is counted the same as a reserve of 50,000. So some of those reserving battles just don't matter anymore from experience rating once you get up to the primary threshold. Now, before the primary threshold does have an impact, but again, loss values above the primary threshold don't have excess losses, so that's sort of the average losses above the threshold that's expected for their industry, and then divided by the total expected losses. Marginally almost understandable, so we think this is this could be a big step forward. But again, that's not 2017. That formula change will probably come in around 2019. So we're on the process of transitioning. As I said, we've issued about we issued 20,000 mods in the first day or two. I'm not quite sure what we're up to, but since the commissioner's decision a couple of weeks ago, there's quite a few of the 2017 mods on the street. And what's the impact? Well, for most of policyholders, again, there's about 120,000 California policyholders to which this applies, the impact's pretty small. But employers with higher than average claim frequency generally will see an increase. There's a small segment, about 5%, 1 in 20 or so, are going to see a big increase, about 10 points. On the other hand, employers that get hit with those shock losses, those big claims, typically will see a big decrease. We'll see a decrease in about 5% of them. Similarly, that 1 in 20 are going to get a decrease of about 10 points. There's slightly more downward adjustments and upward adjustments, but it's all balanced. Experience rating's a zero-sum game, so the net impact of the ones going up and going down because of the formula net out to zero. We're still going to get an average mod around 100 or so. So it's a balance game. This really kind of shows the balance, kind of a red state blue, I don't know, red state blue state thing, but this is sort of the change in mod we estimate for all experience rated employers, and I have one in a second for small employers. And pretty bell-shaped is what we're looking at. This is kind of totally balanced. Due to the new formula, almost 80% of experience-rated employers will either see a decrease, stay the same, or increase by 2 points or less. So there's only about 1 in 5 are going to have an increase that's, somewhat significant or more, or definitely significant. About 22% will either, go up by more than 2 points. So again, it's balanced, but there are impacts of a change, and on this chart, it looks small to look at 2.7% are getting 15 points or more, but when you translate that over 120,000 employers, you're talking a fair about 2,500, 3,000 employers are going to see a big increase. There's probably, hopefully they're none of yours, but maybe some of them are. Typically, and the ones we've seen, because obviously we hear about these, as I'm sure you do, the ones we have seen, almost without exception, are the ones that had a pretty high claim frequency. So often, where you see the most changes tend to be high mods. And if the mod's high, would have been high otherwise, and it was high because of large claims, because they got hit with maybe a $150,000 claim, it's probably going to come down quite a bit. It'll be on that far left side or that far right side, the green side. Because what was driving the high mod was a shock loss or two. However, if what was driving the mod was a lot of claims that are kind of mid-size and small and mid-size claims, they're going to be on the right side. I know one of the risks that came to us, I think it was in Southern California, nonprofit, and they had 87 claims, and the average for their industry expected was something like 27. And so, yeah, they had about a 30 or 40 point swing, because this plan is going to hit those high frequency risks. Because the data says it's appropriate. While on the other hand, the employer had a high mod because they got hit by maybe 2 very large claims, our data says that isn't very predictive. Back to that first scale chart. The fact that they had some large claims doesn't mean they're necessarily going to have a large claim in the future. And we're giving less weight and the formula gives less weight to that. So they tend to be on the green side. Well, and we focus just on small employers that are experience rated, and there's a lot of them out there. Big chunk of that 120,000 are less than $25,000 a year in premium. Again, very, very bell-shaped, kind of what we like to see. And in those cases, less than 1% are going to see an increase more than 10 points, and less than 6% will see an increase more than 5 points due to the new formula. So again, very, very balanced, a little bit less pronounced because typically they're not getting a lot of weight now. So for those employers, most of the impact will be small. Just let me this slide will kind of demonstrate sort of how the plan works and sort of this greater weight to claim frequency. Well, under the old 7,000, it's not current anymore, slide's out of date, but the pre-17 $7,000 split point, a claim-free employer with about $25,000 a year in premium got a mod of 74%. Now they'll get a little lower mod, again, because this formula gives more weight to frequency, so if they're claim-free, they generally do better. On the other hand, if they have a relatively high frequency, this case $500 claims and a $25,000 claim, well, the variable split is going to hit them a little bit harder. They're going to end up at about 119 versus the old formula 111. But on the other, I guess I only have two hands, but on the third case, if one of those claims was a jumbo claim, then the variable split's going to count them a little bit less, actually quite a bit less, because that $150,000 claim's not going to count against them at all. They're just going to pay $11,000 of that claim's going in. So they're under the old formula, that $150,000 claim would have driven their mod to about 140. Under this formula, it's only 119. So people get that idea. So the fact is, under the old formula, some of the losses between 7,000 and 150,000 on that claim were counted against them. But under the new formula, nothing over 11,000 counted against them. So that big jumbo claim, which isn't very predictive, is what our data shows, doesn't hit them as hard. But that $25,000 claim will hit them, and their higher frequency will count against them. Question? I'm sorry? Oh, $11,000 is the threshold, yeah. Remember the idea, that table we went back before, you kind of pick up their 3-year expected losses, and the bigger the expected losses over the 3-year period, the higher the threshold. So for experience rated risk like UPS, it's going to be pretty close to $75,000, but for a very small experience rated employer, it'll be closer to like $5,000. So one of the challenges I know you guys have, that we have too, is a lot of things go into experience rating, and sometimes it's hard to understand why a mod changed, and often it's not the formula change. When we changed formulas before, there's a lot of things that go into it, and this tries to go into it. And one tool we do have on our website, I'll talk a little bit more later, is we have an estimator that allows you to isolate the impact of the 2017 change. So it kind of removes everything else and said, how much did the 2017 formula change cause the mod to change? Because a lot of things, expected loss rates could change. Often, we saw a lot of this in the past where a mod will go up, not because the employer's experience changed, but because the benchmark changed. The experience within the entire industry got better. So they're comparing it now to a lower benchmark, so their mod's going to go up. That can happen. The D ratios, they determine how much the expected losses are primary. They could change. Clearly payroll, the employer gets smaller. That may impact them. Obviously, the claim experience. The claim experience gets better or worse from one 3-year period to the other. That's going to change there. We do get questions about the 3-year limit. That still applies. A couple of years ago, we added something that if there was a single claim in the experience period, only one claim in the experience period, that impact couldn't count more than 25 points. That continues to apply. This demonstrates it. The example that even if the calculation would be 25 points or more, it's limited to 25 points. Doesn't happen a lot. I think there's about 3,000 or 4,000 a year, typically small employers. This was our first attempt to really address some of the volatility, or kind of that over bounce that was coming from individual claims. The variable split goes to that as well. So let me talk a little bit about claim severity. There was a lot of information about a month ago coming out around claim severity. We did a webinar, a Mod Talk webinar around it. Under the 2017 variable split, more weight is generally given to claim frequency. I've talked about that. Our data shows that frequency is more predictive. The first $10,000, $20,000 of a claim is predictive of the future, while the difference between 50 and 100,000 is much less so. And it does focus on that statutory purpose of experience rating, preventing workplace injuries. But claim severity is still a factor. It's still using the XMOT up to the variable threshold. The historical data indicates that claim severity difference at high values aren't predictive. That difference between a $50,000 and $100,000 claim really doesn't mean much when you're predicting the future cost levels. So no weight's given to claim severity differences above the variable threshold. But, as you guys all know, claim severity does remain a consideration in the insurer underwriting and pricing process. So it doesn't mean, while claim severity above the threshold doesn't count anymore in experience rating, I think it certainly will continue to count as an underwriter evaluates the risk in their individual insurer underwriting and pricing plans. Let me just kind of reinforce this in a couple of slides. Looking at the impact of severity. This is how much of an individual claim gets counted in the experience rating formula. Now, for a smaller employer, this is about a pretty small experience rated employer, about $14,000 in annual premium. And under the new formula, their split will be $6,500. Well, it doesn't, any claims counted over $6,500 is counted at $6,500. So all those blue points. Since they were so small under the old plan, the pre-7,000 split, well, they didn't get any excess either. So for them, every claim was counted at $7,000. It was $7,000. So not a very interesting slide. Really not a lot of change there at that size. But if you go to 50,000 size in terms of premium, sort of a mid-size employer, $50,000 a year in premium, well, you can kind of see the differences. At under the variable split there at $15K would be their split point. At $7,000, well, they're going to under each $7,000 claim is going to count in their entirety. But once you get to $25,000, the variable split's actually going to count it quite a bit more. So a $25,000 claim is going to go in at $15,000, their variable split point. Under the old formula, they were only going to get $7,000, but a little bit of the excess, so they got $93,004. By $75,000 claim, they're about the same. It's counted around a little bit more under the old plan than the new plan. But at a $150,000 claim, that shock loss, there's a significant difference. Right, because under the current $7,000 split, because they're getting a portion between $7,000 and $150,000, about $26,000 is going to go into the formula, where under the new plan, it's only that $15,000. One more of these before I beat a dead horse a little bit more is a $25,000 risk, and you see this sort of the same phenomena where under the variable split, their variable split point's about 32,000, so they're going to count up to 32,000 of each claim, and at 70, again, for claims up to the variable split, it's counted more in the variable split formula because they're getting all the values up to the 32,000. Around 75,000, they kind of cross. They're about the same. And then for that big jumbo claim, the variable split still counting only the first 32,000, where the old formula, about 56,000 goes into the formula. So just wanted to kind of highlight sort of how severity kind of plays into it. Okay, I do want to leave a couple minutes for questions, so I'm going to kind of go through this quick. So experience rated, this is the other issue I talked earlier, unaudited payroll. Experience, the plan, the commissioner's rules around experience rating directs that unaudited payroll shouldn't be used in the X mod. So if an audit can't be completed of the policyholder's operations, it doesn't get used. We have a whole process when the insurer reports that the policyholders has not cooperated, isn't cooperating with the audit. We send a letter to the policyholder, explain the importance of experience rating and the impact, and really urge the policyholder to contact the insurer. If we don't get the audit within 60 days, we'll publish a mod we'll use the losses, but not the payroll. So if you got losses and no payroll, you could drive the mod up pretty high for that year that's not audited. So it does often get the policyholder's attention when you get a mod that uses a year of losses with no payroll. But what was happening prior to 2017 was sometimes if you're not using the payroll, remember the payroll goes into the expected losses, the eligibility. So when you didn't use the payroll, often they wouldn't be eligible and not get a mod. So what the 2017 plan change says is it allows us to issue a mod without the payroll if it's a debit, so if it's greater than 100, and they would otherwise be ineligible the fact that we're not using the payroll, because that was sort of a way to get out of the mod, right? By not cooperating with the audit, you could drop below the eligibility and not get the mod that you would have otherwise got. So again, small exception, there's probably going to be only a few hundred of these, probably not a big deal, but we just want to let you know. When we do issue one of these, there'll be a special designation on the rate sheet that excludes unaudited payroll, as you see there. But again, probably not a huge deal. There may be a couple hundred we think we might do. In any case, when we do issue that, again, this is largely to get the policyholder's attention, to get them to cooperate in the audit. Once we do get the USR correction, that gives us the audit exposure, we'll go back and revise the mods and get the mod right. And that applies to it could even be a couple years down the road. So a little bit before I open up to a couple minutes of questions. I want to go a little bit about all we have around experience rating. We've done a lot of outreach, lots of information on our website around it. This is in our learning center at WCIRB.com, rating 2017. Lots of material about the impacts, frequently asked questions. Our estimators, I think these are a useful tool. What we have seen, because there's a lot of things that go into experience rating, it's easy to misinterpret a change in mod to be due to the formula where it's really due to something else. The nice thing about this estimator, oops, I thought we had a little more. Go to our website, use the estimator. What that does is it isolates the impact of the formula change. It kind of removes the noise of everything else and said, what would the mod have been in 2017 if the old formula had applied? So it does it both ways, so you could see mod would have been 98 versus 92, whatever the case may be. And it removes the impact of all those other things that could cause a mod to change. And we have a lot of news and notes, information to sign up to email alerts, but we've done a tremendous amount of outreach on this. I think we have another mod talk. Yeah, there it is. In a couple of weeks, where we'll talk about some of this information, but what we've seen. Now, by that time, we probably issued 25 or 30,000 mods under the new formula. Hopefully, we expect that they're coming the way we expect them to, but we'll see. And we'll kind of give you the status of where we are, what they're coming at, address some frequently asked questions. So they're all free, so encourage you to sign up. And of course, there's WCIRB Connect, has XMod alerts. Something we are excited about that will be coming very soon, probably later this month, we hope, is a new educational platform, a learning management system, Comp Essentials. We're starting with classification. Next year, we'll be adding experience rating, all the issues around ownership and combination of entities, and the rate-making process. Should be exciting. And it is, we're working with the department for CEA credits for licensed agents and brokers. Very comprehensive, self-paced. There's 9 modules to the first one, probably in total about 2 hours of it with questions and very interactive. So we'll have notices coming out very shortly on that, and we hope to have it up later this month. So with that, I think I might want to leave a couple minutes for questions. Anybody have questions about experience rated or any WCIRB in general? No. Anybody use our estimator yet? Oh, is there? Oh, that's sorry. Yeah, it's a good question. The question goes to, what's going on with first aid, collecting data, how it relates to experience rating. Well, I added that, but I'll put it in my answer. So first aid is one of those kind of long-standing issues in California. There's some legitimate confusion out there because there's different definitions. OSHA has one definition of first aid, which I actually think is pretty good. The state insurance code has another definition of first aid, which really allows a medical treatment and a follow-up visit. Feels a little bit more than what most people think of first aid. And in the insurance statute or the commissioner's regs, there's no first aid claims. There's no first aid concept. So that's created a lot of legitimate confusion on what's been reported. Now the WCIRB and the insurance commissioner's position has been for decades, we've probably issued 6 bulletins on it, is that there is no first aid. If there's a claim incurred, the policy contract requires it to be reported. There's no deductible provision, and it goes into experience rating. This year, we proposed, and the commissioner adopted beginning 2017, kind of clarifying what was in bulletin, putting it into the regs, that all claims when dollars are incurred need to be reported, and they're used in experience rating. So that means even if the policyholder pays it, they're required to report it. If there's there's required to be a doctor's first report, it should get reported by the insurer to the WCIRB and used in experience rating. Now, that's always been the case, but putting it in the commissioner's regulations makes it a little clearer than in WCIRB bulletins. And we understand that creates issues on insurers. It's very hard for them to report to us a claim they didn't pay. So that's one approach, the change we made to clarify that they need to be reported. We think it makes sense, and we've worked with representatives of injured workers, representatives of employers, producers, insurers to try to solve this. And what it comes down to is those claims are important. It's important to get, if a worker's injured in the job, they should get into the workers' comp system. They're entitled to be in the workers' comp system. Some of those claims that are considered first aid later blow up and cost much more if the insurer is not managing it. And for a lot of reasons, the sense is that should be used. What we are looking at, probably maybe in 2019 formula, is changing the experience rating formula to not count the first $250 of every claim. So the idea is, if we remove them from experience rating and say if you have a claim less than $250, which should even allow under the California fee schedule, that will include a couple of doctor visits, maybe a couple of prescription. So it really wouldn't typically meet the first aid requirement. If it continues to get reported, but not used in experience rating. So that's kind of how we're trying to address it from that perspective. We still have a little work to do on that. The earliest I could see is probably proposing it next June. That changed the formula, but we would need a year of outreach and education, probably go in around 2019. So maybe when we simplify the formula, as I talked about earlier, we'll also change the plan to not count the first $250 of every claim. We looked at bigger amounts, but the problem... Probably not. Probably that one would be a little simpler. But there is a cost to it because there's a lot of claims out there less than $250. And so what'll happen is that employers who have a loss-free mod, their mod will go up. The loss-free they won't get as much credit because you've taken a lot of claims out of the system. And so their benchmarks will go down a bit. So you'll see now a lot of those 72s might go to 73 or 74. You're not going to see the big swings that this one does, but you will be moving a lot of loss-free employers up a bit. And that was and we looked at doing 500 or 1,000, and the impacts were too big. the cure was too big for the disease. But 250 it looked like it'd be kind of tolerable because the swing might only be a point up or so to really kind of take those claims out of the system. And that's what we'll be working on. And again, the earliest that'll be it'll be a couple years down the road. Other questions, comments? So what are you guys, seeing you guys starting to deal with some of those 2017 mods and policyholders, and any reaction or yet? No, anybody wants to claim to at least. So, well, thank you all. I really appreciate your attendance.
Thank you, Dave. I'd like to remind you all, if you have not signed the sign-in sheet or sign-out sheet for the CE credits, please do so. It'll be probably in the back if you guys haven't done that. We're going to go ahead and take a quick 5. We have another CE class coming up. So if you need to get a drink or go to the bathroom, please do so and come back in about 5 minutes. Thank you.